Well, good afternoon, and excited to be together with everyone again. Particularly excited today to have my colleague and friend joining me, Tom Worthington. Today, we're going to be talking about qualified plans, but again, specifically on cash balance plans and or qualified plans in that regard. So we have some context with that. And Tom, it's welcome this afternoon to our podcast. How are you, buddy?
I'm good, man. Thank you for the invite today. I appreciate this very much.
Absolutely. Hey, Tom, maybe if you would, just for the benefit of the audience, maybe share a little bit about yourself and what you do.
Sure, I'd be happy to. As anyone witnessing this video can see, that I'm not a spring chicken. I'm a little grayer on the sides of the head there. And from a planning standpoint and a life standpoint, I'm very happy to say that I've been blessed in such a way by God that I'm blessed in two ways. One is that I just celebrated my 40th wedding anniversary with my spouse back on October 15th with Cass. I've got three beautiful kids. I've got four grandchildren that I just adore and love spoiling. So, and then the second blessing is that I've got the opportunity to work with folks like Ed and everybody on this team at Pinnacle at an advanced age to provide support in a planning area that I've worked in a great deal of my adult life. I love this discussion around cash balance planning, and if I can be of any assistance to anyone going forward, I'd be happy to provide that support.
Tom, thank you. And again, congratulations. That's is excited to hear that your tenure certainly with your bride and also just the ongoing extension of your family. So congratulations. I know how meaningful it is to you. So Tom, let's talk about cash balance plans. I know that in one of my former guests, Scott McHenry Associates, he talked about his role as a third-party administrator, and I know you work very, very closely with him. But just to do just a quick refresh with our audience here, can you describe or talk about what is a cash balance plan?
Sure, I'd be happy to. A cash balance plan is a defined benefit pension. It's a hybrid defined benefit approach. And what I mean by that is that I cut my teeth many years ago on the old defined benefit approach to the business. And you would set a target defined benefit, and hence the name, and then fund that backing into the assumptions used to come up with a contribution for that individual. We were always prospecting for older, higher paid older and higher paid owners of the business. And the bottom line is that in today's world with the cash balance approach, they're unique because what Scott McHenry and his team does is they can actuarially look at an accrual formula that would mimic the old money purchase plan for any of those that you might remember that. And it really develops a participant account that's a hypothetical account so that gives us the ability for these plans to be scalable and flexible year to year. Why is that important? Because if we set up a target contribution for a business owner today and his business turns south in 3 years, he's going to want to know how much flexibility that he or she has. So these plans are flexible and scalable right from the outset, and it's an opportunity to do a lot of tax sheltering, if you will. The average cash balance plan you will find that will be a contribution level anywhere between 3, 4, 5, 6, 7, maybe 10 times greater than they can do in a defined contribution 401k plan. So everyone knows defined contribution plans are capped at a certain point, but under defined benefit rules, we can then integrate that with that cash balance with the defined contribution plan. And then you have the opportunity to really favor that client in a bigger way in the new plan. So it's a great way to provide exceptional tax planning for the client.
So, Tom, it's interesting you mentioned 401k, and that's typically what certainly advisors and for clients alike, business owners, that there's obviously they gravitate as a foundation, if you will, 401k plans. But you kind of noted something there that almost is the difference between a 401k and cash balance plan. It sounds like it's the contributions and the the tax deductibility of the plan is much greater in a cash balance than a 401k. But can you have both? So go ahead, answer that.
Yes, in fact, many, great question. A lot of our clients have an existing 401k plan, so it's nice if we can talk to an advisor that if they're servicing an existing 401k plan. The idea behind that is to design a defined benefit plan called a cash balance that will cross test and integrate with that current 401k profit sharing arrangement. So what we want to do is get that business owner credit for some of those dollars you're putting away in that 401k and further favor them in the new cash balance world. So it's an opportunity to discriminate legally in their favor. Our average plan design is between 100 and say 5 to 600,000 in contributions for a cash balance plan. But here's the interesting thing. About 90% of those dollars are going to the credit of the owner themselves. So it's a way to really favor the owner who's taking the risk and still provide benefits for the other employees.
Well, a real chasm between what you can contribute to one versus the other, but you can have both. So taking the benefits of both, and particularly interesting. There's certainly as we look at 2024. 2025. I mean, there's certainly a lot of things happening in the legislative environment right now, and
Sure.
tax implications, so forth. And there's certainly speculation, obviously, that income tax is going to move and continue to escalate here, and of course, the application of that to business owners. So, when you think about tax deductions, you're talking about those contributions. Can you talk a little bit about really the impetus of this as it relates to business owners and this new environment of really pursuing tax deductions? How does this land with this?
Sure. It's a strategic approach. So the idea is to first talk about the planning as it relates to the tax planning for that business owner. So I have found a long time ago, Ed, that if you walk in the door and talk about life insurance out of the box, it's a little more difficult to get that warm and fuzzy feeling going, where if you're talking about taxes and a way to maybe help that client mitigate some of that income tax they're faced with, you find a really receptive audience in most cases. So I love this conversation. And when we're designing these plans, think of it this way. We're going to have a contribution that's tax deductible. It's going to be in a qualified plan trust, so the earnings on the trust over a 5 to 10 year window or greater are tax deferred. But the best part about the design that Scott McHenry discusses in terms of modern qualified planning is that we can now take and fund that policy, or excuse me, a life insurance policy over a 5 year window in conjunction with other investments inside the trust. And what that does is after 5 years, beginning year 6, we're going to show the client how to reposition that policy out of the plan, and they're going to end up owning that thing personally. And why would we do that? Because now you had tax deductions, tax deferral. Oh, by the way, you can turn that on for tax-free income from 65 to age 90 for tax-free cash flow. So it's a great way to enhance the tax planning for that client.
So, Tom, you're mentioning life insurance here, and of course, cash balance plans. It's certainly life insurance is certainly, I guess, a consideration for what you're saying here. But it sounds like having life insurance in a cash balance plan is kind of yielding some interesting benefits there. You're mentioning tax-free is. So why put life insurance in a cash balance plan? I'm just curious, what are the benefits of that?
Okay, there are several benefits. The most obvious benefit, Ed, is that it provides for self-completion. So if I have a $2 million death benefit in my plan, and the plan's the owner and beneficiary of that contract, and I made my wife the beneficiary, and I die in the first 5 years of funding, that money would flow through the trust and right back out to my spouse. And you get a tax break on it because the only taxable portion of that asset is the cash values. And beyond, and really it's not even that, because there's the table one cost can be excluded from that as well. So from a planning standpoint, if I outlive that and reposition the policy, and then, oh, by the way, I meant to say, if you die in that funding period, that is completing the retirement benefit. So if I had 3 years of contribution, I wouldn't have my retirement there for my family, but I've now got it funded because of the insurance. Now,
Mm.
that's not the primary reason, believe it or not. The primary reason is that it's a tax leverage play. So we have the ability to reposition that policy after 5 years, either to me personally or to a family member or a grantor trust can actually end up owning that policy outside of the plan and with no adverse income tax consequences. So it's not a prohibited transaction for an ILET to purchase that policy from the plan and have it automatically outside the estate. And remember, it's already funded. So we did a 5-year funding on a deductible basis. There's no other place on God's green earth, and I know you can do that.
That's excellent. Life insurance inside the cash balance plan, self-completing is what I heard you say.
Yep.
Also, greater tax deductions, I'm assuming because of the premium. Is that be?
Yeah, I should have mentioned that. Yes, sir, that's correct. On average, the amount of contribution we can make for the first 5 years will increase about 21%. So it means further income tax savings to the client for 5 years. And then after year 5, year 6, then the contribution will revert back to the same table everybody else will be with.
Excellent, excellent. So, Tom, clearly, listen, I know this is this is where you have your expertise in, and I think it'd be really beneficial for the audience. Of course, you've given a great overview of what cash balance is and some of the intricacies that are involved with that. But if it's, I'm kind of curious to the extent, what your role as far as what would they experience? I mean, what are the things that you do, steps that you take, either a business owner and or an advisor, to kind of really shepherd this all the way from beginning to end? Can you talk about what your
Sure.
process?
Yeah, I'd be happy to. This is a wonderful opportunity for me. The bottom line is that I get to approach this conversation early with an advisor and give them the benefits of the planning, to talk about why these things really work for the business owner. And if they have an interest and they have someone they think they would like to present this to, then our TPA uses what we call a starter kit. So we have a fact finder, 4 pages long. It doesn't take much effort to get us the information. We get that to the advisor. They get it to the client to complete and send it back to us. Or I'll offer to take the data for them with that client. And then once we get that data form back, then it goes into queue at the McHenry for design. Once it gets designed, usually in 5 to 7 business days, we get it back and we get what we call a study. That first study then will show the client and the advisor first on what the moving parts are of that plan and how it operates. Once the client sees that, or we present that, we'll offer to present that to the client. We also recommend they always incorporate the CPA. They sign the tax return, so it makes sense to have the CPA as part of that discussion. And when we do that, we'll present that on their behalf. And once the client says, okay, Tom, I'm ready to go, what's the next step? Then what we do is we have a page form that will ask the client as the plan sponsor to sign, saying this study is what is the correct one. We get it to McHenry. They assign one of their actuaries and consultants to the case, and then they start working with us jointly. And then we have a list of step-by-step approaches are used on the backside to implement these plans. So the first step is we're going to get tax EIN numbers, and they're going to send them to us. Then it's going to allow the client to let us also get a DocuSign sent to them on the service agreements with McHenry, because they're going to agree that I'm going to do this service for this fee, et cetera, et cetera. Once all that's done, they're going to send us then the documents, the trust documents based on the plan design. When we get those documents, that is the information along with the EIN number. Then the advisor can go ahead and set up their investment trust. It's usually a pooled account for a cash balance plan. They'll set up that account, and then they will look to have checks written to that account and managed on behalf of the retirement plan. And from there, every year, we're going to get those reports from them in terms of earnings reports and new census information, turnover, those sort of things. We get all that to McHenry. The actuaries do their job. And then every year, McHenry then provides a minimum and maximum contribution range for that client every year. So it's truly one-stop shopping. And then they'll do the tax returns and information on the back end.
Wow, excellent. So, Tom, it's um, a lot of steps in the process, and if I heard you correctly, from fact finder to study, and then it's in the actual presenting to which you have the CPA. My assumption is, or maybe just correct me if I'm wrong. Are you actually working with the advisor with the client?
Yes.
Are you
Yeah,
client?
I want the client, the advisor, and the CPA on the same call if we can make that come together.
Wow. So really, on the front end, it seems to be very simple. As if I may just parrot it back, I wrote down fact finder study, presenting. Obviously, you want to have the tax professional involved that could be involved with the client to be there. Plus,
Sure.
from there, it just goes. The next steps is going in from the plan sponsor agreement to the TPA. Now gets involved with. They got actuaries. You're getting tax, EIN number.
Yep.
Service agreement. You're then moving into the trust document, and then it's kind of talking about just the allocation of investments and kind of go from there. But it was really interesting. I think with a lot of plans that you're doing, you mentioned that there is also a kind of an annual review, reporting, and tax filing. It
Sure.
sounds like you're providing those services through McHenry as well. Is that correct? Did I hear that
That's
correct?
correct. McHenry is providing the annual review, and we're supporting that. That's correct.
Mm-hmm. So the process from inception to I guess to closure. I mean, I think obviously in a perfect world, but just typically, how long does the process take?
Well, that's a fun question to answer because life is never the same for any two opportunities or two clients, right? So
Right.
I have the advantage to say that I just today got an email confirming trusts were sent up and it was confirmed by the client that we're ready to move forward on a plan for a dentist.
Mm,
That dentist started talking to us a year ago.
okay.
So it was a year-long conversation where it took that much time for the client to get comfortable for a number of reasons.
Mm,
So, but if you talk about someone who's motivated for taxes, and by the way, we got that tax mulligan thing going right now, where if they sign and execute an income tax extension, now we can talk about they have until September, October to get this done even for 2023. I didn't mention that, but that's pretty big.
okay.
So,
Okay.
and I've got a plan right now that we're working on that we're closing, and it's only been in play for 2 months.
Wow.
So 2 months is probably a good target range, but it can be a lot longer based
It can
on
be
circumstances.
elongated. You can, in a perfect world, it can be it can be
Yeah,
with an
perfect
eight.
world is 2 months.
So that's good. And really a good catch there, Tom, is you referenced tax mulligan that for business owners that are looking for significant tax deductions, they can do that, putting a
Yep.
plan in place and get that deduction for 2023 up until the time that they actually file. Did I get that
That's
correct?
correct. As long as they set up the plan, make the contribution prior to filing taxes, they're good to go.
That's great, Tom. Well, listen, first and foremost, I want to thank you for being with me this afternoon, kind of sharing insight. Again, really doing a review on cash balance, but for you to go through the processes, I think it's going to be invaluable for an advisor or for a business owner to hear this so they can see that number one, they could take advantage of taxes for tax deductions for 2023. But the process with someone that is motivated, it can be done within 2 months, and it can actually, or it can be longer, depending on where they are relative to their priorities. But Tom, I
Yep.
appreciate you being with me today, and in this edition of Next Level Advisor podcast. So, listen, have a
All
blessed
right.
day.
Thank
Thanks,
you, Ed.
and we'll talk soon.